Hey there, everyone. Happy Friday, January 24th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually beautifully sunny and clear Redmond, Washington. I know a number of you around the country in places where you're not used to having plenty of snow or having plenty of snow. I just heard from one of my Market Misbehavior Premium members in the bayou in Louisiana, talking about 8 inches of snow on the ground. So, oh man, be careful. You're in parts of the country, a little bit of snow can cause havoc with drivers that are less than familiar with those conditions. So, as someone who lived in Boston and New York and Northeast Ohio and dealt with heavy snowfall, I wish you guys well. Take it slow, take it safe, and be well, all of you. Today we're going to do an all mailbag edition. It's been a fun week. I mean, tracking these market conditions as they evolve. We're recording this midday on Friday, the 24th. Market sort of stable during the day, but really rolling over going into the afternoon. Sort of a weak finish so far. We'll see what happens in the last 2 hours of trading. But if we would finish in a position of weakness, what has felt like one of the most bullish weeks in recent memory, all of a sudden becomes a little asterisk, right? Pretty good week until Friday sort of rolled over. So something certainly to watch as conditions kind of evolve here. Defensive sectors like utilities and real estate in the top 3 performers today. Plenty to continue to talk about. We'll be back with the live episodes on Monday of next week, tracking evolving market conditions. But today we're going to do an all mailbag edition. I love these mailbag shows. Honestly, during every show, it's great to see questions as they come in. I love taking a question or two when it makes sense. But an episode like this really gives me a chance to explore some good questions a little more thoughtfully, a little more deliberately, and hopefully help you make sense of things. So let's do it. Let's get to question number 1. All right, Dave, thoughts on VXF and AVUV from a technical lens? Thanks so much for asking about these. These ETFs, if you're not familiar, VFX is a Vanguard. I couldn't remember the actual name. It's a Vanguard extended market ETF. It's sort of a SMID ETF, and SMID, small caps and mid caps, kind of mixed together is what this is. There are a number of ETFs that kind of play in the outside of the large cap space. So the S&P, the NASDAQ, obviously dominated by the mega cap growth names, but also comprised of large cap names for the most part. ETFs like this, like the IWM, like the MDY, anything in mid caps and small caps, kind of give you a different area of the market. Now, generally speaking, these are ETFs that have probably underperformed, generally just because of the dominance in the Magnificent Seven. AVUV is one I don't look at a whole lot. Small cap value. Okay, so I usually use the what are they? Things like IJ. What would that one be? S&P 600 small. I was going to say that's the SLYV is one that I've used. There are a couple of them. There's so many. Russell 2000. This is the one I was thinking. Russell 2000. This is the one. The IWN, which is the Russell 2000 value ETF. There are a bunch of ETFs, and Fidelity and a lot of other providers kind of all have their own versions of these. And depending on what platform you're on, you might get a better, a cheaper, like lower commissions, although they're pretty much zero across the board these days. You might have a better opportunity because that it's a branded ETF. Generally with these, I would encourage you to just look at liquidity, make sure they're big enough. Both of these seem fairly liquid. Make sure the spreads are narrow. Make sure that look at the performance of these ETFs versus others. So let's look at VXF for a second. So I will tell you, from a technical perspective, you can compare, look at this. And again, the challenge is compare it to the S&P, right? The S&P sort of pushing to new all-time highs this week. VXF is not doing so. The problem with VXF is the problem you have with any small cap index or ETF. There have been times when it feels like a really good performer. And I would say from a purely technical perspective, what I really like about this ETF, if you're looking at it, what am I doing? Annotate. If you're looking at this, is you have sort of a gap here, and the S&P kind of has that gap as well. Sort of look at that gap here, that November gap, and you can see we actually went slightly below it on this chart. It looks like, or certainly right to the end of it, but it did end up filling that gap. I mean, a lot of people talk about gaps being filled. I generally think of this as a support range. You can see that we hit that. That was the gap higher around the elections. We made a new high above 205. We pulled back into that gap. That's why I think of gaps as support and resistance ranges. So the fact that that has held and now resolved back to the upside, the fact that we broke back above the 50-day moving average, all bullish. The fact that the RSI may be pushing above 61, that would be encouraging. I think getting to new all-time highs is the most bullish thing you could see at this point. Another thing I would want to do would be look at something like Chaikin money flow, which looks at the volume, but relates the volume to the price action day in, day out. You can see the Chaikin money flow is negative from early December to now early January, similar to the S&P, and now has broken bullish. So I would say the things that I like about this chart are a lot of the things that I like about other charts like the S&P. They're going up in the last week, and it's caused a bounce off of gap support, which I think is pretty encouraging. So from a technical perspective, a good chart, and I think this is one that looks pretty strong. The problem is, do you want to own this versus other things? And one thing I will tell you, and I'll talk briefly as I'm doing this, look at correlations, particularly when you have an ETF like this. So let's look at the correlation to the SPY. Because this has kind of small and mid caps, we'll do the correlation to the MDY. And here we'll do correlation to like the Russell 2000 ETF. So what I'm doing is a rolling 20-day correlation to the S&P 500. So large cap stocks, mid cap stocks, and then small caps, the Russell 2000. So here's what those series look like. And this doesn't surprise me. It's kind of what I would expect. Generally positive correlation to the S&P 500, but with notable exceptions, particularly back here in like June, July, August. You can see it actually made a new high in July. August pulled back. This is when the S&P was, kind of cratering. And so the correlations kind of fell apart there over the summer, but since then have generally been positive. If you look at the correlation to the mid-cap ETF, the MDY, even more consistently positive. Still some little hiccups, but generally pretty positive. But look at how strong this correlation is to the Russell 2000. It's almost the same thing. And so I would say as much as different providers like Vanguard and Fidelity and iShares and all the other ETF providers, they have their own things with kind of different structures and they try to differentiate them. Correlations don't lie, right? And if you look at some of these, like you're pretty much owning the Russell 2000 if you buy VXF. And I don't have a problem with that. I'm saying don't think that you're diversifying by owning the Russell 2000 and the VXF as like different plays on a space. Like they're the same thing. So it should be more of a thought about fees and expenses and spreads and structural nuances between them, and just go with the ETF that offers. I would generally say for most people, go for the ETF that offers the cheapest access to a particular theme or a particular market, and assure that it has enough liquidity, meaning that there's enough volume that buying and selling isn't a problem, and that's overall going to serve you well. That was my technical lens, but also more of a structural kind of due diligence lens. Correlations are really helpful if you're looking at different ETFs and just want to understand what kind of bet you might be making. I'd encourage you to check those out. Next question, what is better, simple or exponential moving averages? I get a version of this question often, and I love to answer it in as many different ways as I can come up with. So I would say it depends, right? This is one of those where it depends. It depends on what you're trying to do. I am a huge fan of looking at simple moving averages. Most of my charts, as you can see, have the 50 and 200-day simple moving averages on there. I've done that from the beginning of my charting experience in mid-2000 at Bloomberg. I started looking at charts kind of like this and have changed the indicators, but the 50 and 200-day have been pretty constant. The reason why I'm so convinced of the value of these is number one, I've used them for so long that recognizing how the price plays between the 50-day and the 200-day, recognizing pullbacks to the 200-day as having an important meaning, looking at the distance from the 200-day moving average as a measure, using breadth indicators based on these moving averages is just part of my process. So when I see something today, I'm mentally going back to all those other times when I've seen that particular combination, and so that's why I think it has great value to me. I would also tell you, having worked with a lot of professional money managers that are not big chart investors, more fundamental investors, but do occasionally look at charts, they almost always had the 50 and 200-day moving averages on them. Our trading desk at Fidelity, those guys would know if a stock was at its 200-day moving average because they knew that that would probably mean there would be some sort of action around the 200-day. So people managing a lot of money and knowing what they look at, I'm happy looking at things that I think they're looking at as well. So that's why those have value. Now, having said that, if I'm designing a trading system to try to best capture trends in Apple, I'm not using simple averages. I'm using exponential averages. This is why my market trend model, which I refer to all the time, it's the first chart I look at every morning. And it's something that I refer to often with my market misbehavior premium members. It's all based on exponential moving averages. Because if you really want to, define a trend, exponential averages are more weighted to the more recent data. And the problem with a 200-day simple moving averages, what happened today and what happened 199 years ago have equal weight. And one would argue that's probably not true, right? What happened more recently is probably more important, and that's fair. So an exponential average allocates a certain percentage to the most recent observation. So when there's a turn, the exponential average will almost always, react more quickly. And so, for trend following, for defining changes, if I was creating a trading system or a signal system based on trends, I would always use exponential moving averages because they're just a better way to define the trend. I have done some videos on my YouTube channel kind of teasing out those relationships. I'd encourage you to check those out. If I can remember, I'll put a link in the description, but I tend to forget that kind of thing. But that would be my answer. And so I use both, and I use them depending on what I'm trying to actually do. I would think about what goal you are trying to accomplish, what questions you're trying to answer, and hopefully that can help point you in the right direction. Next question, what's the significance of the gap from November 6th now being filled? And I kind of talked about this with the first question today, and maybe that was on top of my mind because I remembered this. Remembered someone asking about it. I would say with the VXF, we talked about that gap being tested. I would say with the S&P, we have a very similar sort of thing, right? So this is that gap here. And again, this is the election gap. When Trump wins, the market takes a big jump higher on expectations of some of the things we would be looking for. If you look at this, I mean, look how beautifully. This is why I follow gaps. This is why I always take a gap and draw a rectangle with the initial gap as that range, and then I just follow it, because more often than not, we come back to test that gap. And some have done extensive work on different strategies with gaps. I don't tend to be that complicated, as you probably can guess if you watch my content. I like to simplify more than anything. So for me, just thinking of it as an important range, recognizing that prices testing that gap support is meaningful. That's enough for me. That's kind of what I want to focus on. And so I would say the significance is, it's a level. So as we rotate lower, that's where you expect buyers to come in. Now, we were focused a lot on 58.50 and that breakdown. Looking back, I probably should have thought more of this as a support range based on the gap. I didn't have it on the chart. I hadn't drawn it on there on some of the daily S&P charts that I'm looking at, and maybe that's what caused me to be more negative here than I probably should have been, given the rally that we've seen off of there. So, markets finding support at previous price gaps is a tried and true scenario. I would say if we roll over from here, we're getting a bit of a bearish candle. I mean, if this was the close, this would be a dark cloud cover candle, which is a bearish short-term candle. If we would go back, I mean, you'd expect significant support kind of in that 5,800 to 5,850 range based on the gap, based on the previous tests of those levels. And that's how I would think of it going forward. Great questions so far. We've got 3 more to hit before the end of the episode. I did want to let you know, though, I have a webcast coming up next week. Next Tuesday, January 29th, 1 p.m. Eastern, 10 a.m. Pacific. I'll be doing a webcast called The Morning Coffee Routine, Strategies for Success. The morning coffee routine is something that's super important to me. I literally, when I coach people on their investment processes, I always ask them, what's the first thing you look at every morning? What's your morning coffee routine? You get the cup of coffee, you fire up the computer. What do you look at? And I find immediately when we have a conversation, you can find some things to improve on. And if your answer is, I look at financial television, I look at my brokerage account, those I would argue are wrong answers for most, if not all, traders and investors that I've ever worked with. And I'll explain why on the webcast. You can sign up for that free event coming up next Tuesday, the 29th, by going to marketmisbehavior.com/morning, or just scan the QR code that you see on your screen. I would love to have you join me for that. free event coming up next Tuesday, and hope you will join me for sure. All right, let's continue on with three more questions here. A bull flag pattern consists of lower highs and lower lows, which can also warn of a downtrend using other metrics. Absolutely right. What are your thoughts on bull flag patterns? So you're right, and we talked about that. I want to say with the Qs, right? Because they had, the S&P has kind of a bull flag pattern. I would say with the QQQ, it's a much more clearly defined bull flag pattern. This is the pattern here. Let's zoom in a little bit. So a bull flag pattern is where you have a rally phase and then you have a pullback. So a rally, right? A general primary uptrend would be higher highs and higher lows. That's what we saw from the August low up until the December peak. Then we have a short-term pattern, and that's the answer to your question. On a smaller time frame, we have a counter trend move of lower highs and lower lows. The signal here, right? The setup is when we form the pattern. The trigger would be closing above the upper trend line formed by the swing highs. And then the confirmation would be another day moving higher. So we got 1, 2, 3, all of those things suggesting an upside breakout for the NASDAQ 100. Now, what makes it a bull flag and not just a new downtrend? It's all about the time frames, right? The trend lasted months and months and months. It's about a 5-month uptrend. And then the pullback is just over a couple weeks. So this can happen on different time frames. Right? On a weekly chart, a bull flag may be a couple months because a weekly chart is looking back 5 to 7 years. So the idea with a bull flag or a pennant pattern is that it's a much smaller time frame relative to the larger time frame that you're using to define the trend, right? So we might look at the S&P or the NASDAQ at any particular time and say it's in an uptrend or a downtrend, and we might both be right, but it's just the time frame. If I'm looking at an hourly chart of the NASDAQ during this period, it's a clear downtrend. But if I'm looking at a weekly chart of the NASDAQ for the last 7 years, it's a clear uptrend, right? So we're both right. It's just a question of what time frame we're thinking of. So a bull flag, on a daily chart is a couple weeks. Generally speaking, that's kind of how I would think of it. And so this kind of fits into that methodology very, very well. Now, as always, I think you're monitoring to see what happens next. Once you have a breakout of a bull flag like here, it's all about, do we eclipse the previous highs? Now, while the S&P has pushed to a new high this week, the NASDAQ has not. We're getting what could end up being a bearish engulfing pattern on the NASDAQ here on Friday. So suggesting maybe we're making a double top formation after breaking out of that bull flag pattern. There are great resources that talk a lot about price patterns. The John Murphy book, which was the first that I ever used, technical analysis of the financial markets, was a way that I originally learned about that pattern. The Edwards and McGee classic book, Technical Analysis of Stock Trends, really is the authority on price patterns. It was written in the mid 20th century, and a lot of what we still use now is based on that foundational work. Both of those books featured on my recommended reading list. Go to marketmisbehavior.com/reading list for those two classic technical analysis books, along with a bunch of other things for technical analysis, trend following, behavioral finance, personal development, all sorts of good stuff. Next question. Seems like the junior miners, GDXJ, are lagging in price terms, but fundamentals like the price of gold are actually getting better. Fair point. What's the explanation? Yeah, indeed, right? It's so funny. I mean, I spent a lot of my career working for big money managers, big financial institutions, and working with investors and other analysts that were not technical, that were not chart people. They were fundamentally oriented investors. And one of the things we would often talk about at Fidelity would be, when are the fundamental and technical analysts in agreement on a particular stock or a particular group? And that would be good. And what we found actually is when the fundamental, technical, and quantitative groups were all bullish on a particular theme or chart, that was usually a really good place to be. And so we actually would run a regular screen called the trifecta screen, or the trip aces screen, basically, where all three groups were in agreement that something was a good idea. But we also learned a lot from when the fundamental and technical groups would disagree, right? When the fundamentals looked good, but the charts looked bad. When the fundamentals looked bad and the charts looked good. What I will tell you in my own experience, what we often found was that technicals would often lead the fundamentals, right? The chart is a good reflection of emotion. It's a reflection of investors anticipating an improvement in fundamental stories. the fundamentals would often, the reason why the price was going up would often be reflected later as quarterly reports from the companies would reflect what sort of themes the charts kind of identify. Now, eventually, the price of equities tend to trade to their fundamental valuations. I think that's a reasonable way of describing equity investing. But in the short term, technical analysis can tell you a lot about when there's a disconnect between the fundamentals and the technicals. And that's because stocks are traded by humans that have very human emotions, and they overreact and underreact to fundamentals and news and all those other things. So there's my philosophical answer to your question. In terms of actual practice, what's up with the junior miners? So the GDX we've brought up before, the GDXJ or some of the smaller gold stocks, but a similar kind of idea. So what's up with these, not doing as well as you might expect? So gold and gold stocks tend to move together, right? And so, if you think about it, a company whose job is to get gold and sell it, the higher gold is as a future, right? The higher the price of gold it goes, the better that's going to be for a company whose business it is to get gold out of the mine and sell it, right? That makes sense, intuitive, totally logical. But there's a disconnect there, because when you're buying a company, you're not just buying the price of gold, you're buying the company's ability to get that gold and do stuff with it. And so I think that is where there can often be a disconnect. And I would say the price of gold, if I'm trading something like gold miners, I'm first looking at the chart of gold, and I want to ensure that, the GLD or $ gold, which is the gold continuous contract on stock charts, I want to make sure those are good charts. I think the chart of gold is, and I do own GLD in terms of full disclosure, as a long-term holding, because it's a great store of value, and from a technical perspective, great long-term chart, undeniably so, I would argue. The GLD is testing new all-time highs. Here's the GDXJ, which is definitely not doing that. So when you see the price of gold going very strong and gold stocks lag behind, we would often talk about a potential catch-up trade. Okay, the charts of the gold miners aren't reflecting the fact that gold prices are trading to the level that they are. So maybe there's an opportunity to buy gold miners, which are essentially undervalued relative to the price of gold, and ride that higher. There are times in market history where the opposite happens, where gold prices start to rotate lower, but gold stocks continue to go higher, which is also a head scratcher. Like, hold on, why are people bidding up gold stocks if the price of gold is going down? And it's probably because an expectation of where gold's going to be down the road, right? What you have to think about is, gold, when you think about a gold company, you're thinking about their ability to make money months and quarters and if not years down the road. So maybe the expectations have changed. But I would argue the process for me certainly would be look at the price of gold. First, this is one of those times where the price of gold has done better than gold stocks. And so arguably there's a great catch-up trade to be made. You're starting to see them bounce in 2025. Maybe this is the beginning of a catch-up trade to what we saw. I would also say you can do a ratio. So do the GDXJ versus the GLD and just look at where how these two have performed relative to one another. Because what you can also think about, and this is what we'd also often think about with institutional investors, all right, I want to buy the gold theme. Should I buy spot gold? Should I buy gold futures, play directly the price of gold? Or should I buy these companies where their business is built on gold? And maybe something like this tells me, well, the gold stocks have been lagging. So if I think gold's going to go up, maybe this is an opportunity to buy on something that's a little undervalued relative to where it should be based on my expectations for the price of gold. So those are the ways that I would explain it. And I would tell you market history is filled with prices of equities disconnecting from what they should be at versus their fundamental valuations. That's why I would argue technical analysis has a purpose. This is why I would tell you that the markets are not as efficient as academics would tell you. This is because their prices are driven by irrational investors, and things like this happen all the time. Last question, and this is a quick one. Do you share your watch list or your holdings on stock charts? I had a great conversation years ago with a good friend of mine, Kevin Moore, who's a longtime money manager and wealth manager, and then had a fantastic career educating the Aggies at Texas A&M, helped create their MSF program, and has become just a really good friend over the years in the industry through the CMT Association, where we served on the board together at times. I remember talking with him years ago when I left working for big institutions and started off on my own and set up a website and started writing a blog. And I remember talking to him, and he said, there are kind of two ways you could generally go. You can go the money management route, where your goal is to, pick stocks and tell people what you're picking and tell people what you're buying and selling, and make money based on, having an ETF or a fund and growing it that way. Or you can tell stories about the market and help people understand it and educate them. And those, while some people I think try to do both, there's a different mentality that goes with those two things. I have managed money and have had opportunities to do so, and I've enjoyed it absolutely zero. I don't enjoy that process at all. I find it incredibly stressful managing other people's money. I get stressed out enough managing my own money, and a lot of the tools and techniques I've developed have been to help myself deal with my own behavioral biases and managing my own portfolios, right, and working with others that do it. So my role, the reason why I have a show and the reason why I do a show like this and run a podcast and a membership service to help people make better decisions, because that I feel like what I'm better at. And so I'm trying to do something that I feel like I'm good at, where I think I can add value for all of you. So the short answer is no, I don't share a watch list or holdings. I do a little of that. And with my premium members, we often talk about individual stocks and ideas. I'm happy to share constructive charts that I think have good upside opportunity, charts that have been doing well that I think are stocks that I would probably be selling. But I don't do that in the form of a model portfolio or anything like that. My goal is to help you all make better decisions of your own and have good holdings in your portfolio based on what we talk about. So that is my answer to the question. And I hope what we've done on today's show and on the rest of the show, Chart This with Dave Keller, and with our podcast has been helpful for all of you this week and for many, many weeks to come. As a reminder, we do have a couple podcasts that we've released here. I sat down with Nishant Pant earlier this week. He is an author of a book on using technical analysis to structure options trades. So if you're unfamiliar with options, it's a really good primer on a particular trade called a bull call spread, how you can use charts to structure that trade. I thought it was really, really well done. Also working on my latest episode with Jeff Hirsch, sort of the king of seasonality. I'll share with you very soon. We'll have that posted hopefully by the end of the day today. And if not, maybe tomorrow morning on Saturday. But a great conversation about seasonal tendencies in a post-election year, what's on his outlook for 2025. But I wish you guys a great weekend. I wish you all well, and we'll see you next week. Remember, it's always a good time to own good charts. Take care, folks.